We at Paxful believe that everyone should have a way to pay bills, purchase goods, send money, and build your own business with Bitcoin. On Paxful, there are more than 300 ways to buy and sell Bitcoin. Be part of the peer-to-peer community. Create an account today.
What is up, Bitcoiners? This is CK, and I'm really excited to bring one of the emerging stars in at least the Bitcoin macro space, but obviously someone who's been extremely established and been doing some fantastic work in the greater macro space. Lyn Alden, welcome to FedWatch.
Hey, thanks for having me. Glad to be here.
Lyn, why don't you introduce yourself to the audience for those who haven't been paying attention and don't know you already?
Yeah, so for people not familiar with my work, my background kind of blends engineering and finance. So I started out in engineering. I went more and more towards engineering management or managing the finances of an engineering facility. And I've been investing for about 15 years now and writing about it publicly for several years. So I run a research firm, Lyn Alden Investment Strategy. So we have free content. We also have a paid service, and then I do some partnerships. So I partner with George Gammon and I partner with Elliott Wave Trader. For people that kind of want to blend certain things, like I focus on fundamentals. So I partner with some technical analysts, and I partner with George. Kind of a couple different ways to see my content.
Awesome. Yeah. And again, I've been really enjoying your entrance into the Bitcoin space in particular. We are going to be talking a lot of fundamentals on this show. But before we get into all of that, wanted to ask you, what's your experience been like joining the Bitcoin community and starting to, tweet about Bitcoin and write about Bitcoin? I know a lot of people have gotten a big bump from Bitcoin enthusiasts on Twitter in terms of engagement. Kind of curious, what you're seeing there and if you've experienced anything in particular.
Oh, it's been positive. I think most of my Bitcoin interactions on Twitter, because my website's been around for a while, and I also write for Seeking Alpha, and so that's not very Bitcoin heavy. But when I started writing about Bitcoin a little bit and talking about it on some podcasts, I definitely got a lot more. A section of the Bitcoin community began following me on Twitter, so that definitely added probably several thousand followers from that, and so it kind of blended a couple different worlds because on Twitter I have the gold investors follow me pretty notable extent, back row investors, stock investors, they that's kind of the set I already had, and then now I'm kind of like pretty firmly entrenched in the Bitcoin community as well, which so far it's been very positive. I guess the downside is occasionally I get spam emails about why I should go to Bitcoin Satoshi Vision or something, but besides that it's all good.
Hi, Lynn. So yeah, we've heard you talk a lot in the past about different times in history. You're a real good economic historian from my point of view. But I wanted to see if you could tell us what time in history is today's market like in the past? Is it like the 30s, the 40s, the 70s? What do you compare it to?
Yeah, that's a really good question, and it's actually a hard one to answer, but I have done a lot of kind of historical comparisons. So I most closely link this to the early 1940s. And that's, there's a couple different reasons for that, and there's never like a perfect, comparison because there's that quote like history doesn't repeat, but it does rhyme, right? So it's kind of like, it's always an echo from the past, but sometimes you kind of blend two different decades together in a kind of a new way. I can talk about that a little bit, but I think the closest period is probably the really early 1940s. And the reason for that is, Ray Dalio, the founder of Bridgewater, popularized the concept of a long-term debt cycle, which is over 5 or 10 years you have the short-term business cycle, which is the normal kind of re-leveraging and then deleveraging event, the boom and bust cycle that we all know pretty well. But the thing is that over multiple short-term business cycles, debt never deleverages all the way down. and then it starts kind of building up again. And that's, there's a lot of reasons for that, and a lot of it due to kind of monetary policy. They cut interest rates, and they encourage that deleveraging to stop and start building back up at a pretty quick rate. So over multiple business cycles, you get lower and lower interest rates, and you get higher and higher debt levels. And that kind of repeats itself until interest rates hit zero. And that's kind of when the music stops, and we kind of have a very different environment. And that only happened, about twice in the past century. So back in the early 1930s, that was the previous long-term debt cycle, where we had a bunch of debt built up in the system, interest rates went down to zero, and the central bank had to turn to all sorts of novel things to try to inflate their way out of that, because they ran into the zero bound. And that happened again in the aftermath of the 2008 financial crisis. So that's the second time we ran into a massive kind of debt accumulation and ran into the zero bound. And so those two periods were very similar. The 2008 2009 crash compared to the 1929 early 1930s crash. So if you take that kind of starting point and you shift it forward to the next decade, the 1930s was a very kind of a heavy kind of, we had a banking crisis in the early part of it, and then we had kind of a lot of central bank policy. And it wasn't really till the 1940s that we started to get really huge fiscal deficits. And of course, that was tied to the war. And so if you kind of go forward to now, we had a banking crisis in 2007, 2008, 2009. And then we had kind of a slow recovery throughout the 2010s. We had a stock boom, but we didn't really have fast GDP growth. And of course, now in 2020, we have the pandemic, and we have fiscal deficits that kind of rival some of the years we saw in World War II. So in many ways, the 2020s are shaping up to look more like the 1940s in the sense that we're running very large fiscal deficits, and we're still kind of on the downward slope of a long-term debt cycle playing out. And this is also, the last time we had federal debt to GDP this high was also in the 1940s. So we have to go back to that period to find a similar outcome. And now I do think that you can point to the late 1960s as kind of a similar environment, right? Because we had very low interest rates, we had very high stock valuations. But I think that's kind of the second closest comparison. But I would point more to the early 40s, or kind of a blend between the early 40s and the late 60s. That's kind of the two periods that I think are most applicable.
So, I mean, one key difference between now and those time periods were, in at least those time periods, there was at least some sort of gold standard involved with the dollar. Can you talk about the fact that the dollar itself, as a pure fiat currency, is the global reserve currency now, and gold is really kind of detached from that, and how that changes the dynamic?
Yeah, part of the monetary policy in the early 1930s was changing the gold peg. So because before that crisis, they had gold was pegged, so it was about $20 an ounce of gold. And then when they depegged it and repegged it, they pegged it at about $35 for an ounce of gold. And that was part of their currency devaluation process that normally comes with long-term debt cycles. Because when they run into the zero bound, they instead turn more and more towards printing money and currency devaluation. We saw that play out. We saw, it wasn't immediately inflationary, but as you moved further into the decades, it did get more inflationary, especially when that fiscal spending heated up. But there's still kind of some sense of stability there, because it still was pegged to gold, even though it was pegged to gold at a lower rate. Now that system started to kind of break down in the 60s, but it was kind of underneath the surface, because you still had the official gold peg, at least in an international sense, right? So it was actually Americans were banned from owning gold, and it was no longer redeemable for gold, but as an international trade unit, it was still technically gold backed. And so we started to kind of have that breakdown because we were running very large trade deficits. So our gold was flowing out of the country, and the euro dollar market, so the offshore dollar market, was really kind of growing like wildfire. And that just didn't work very well with the gold standard they had set up, because those dollars could multiply, and then those were redeemable for gold. So that kind of combination was slowly kind of decaying the gold standard underneath the surface. And of course, it didn't really come to a head until 1971, when they went off the gold standard, and the dollar devalued very significantly. So that's in some ways why this period, I think, is somewhat similar to the late 1960s as well, because that was kind of a major change in the global monetary system. So if you look at, the long-term debt cycle was 30s and 40s, and then again, this past kind of 15-year period. So that's kind of one set we can look at. But then the other set is to look at big changes to the global monetary system. So the way that kind of multiple countries organize their finances. So of course, after World War II, you had the Bretton Woods system, but that kind of changed in the early 1970s to the petrodollar system, and we've been under that standard ever since for nearly 50 years. So I think now we're kind of in the process where we're going through that long-term debt cycle, which is very similar to the 40s, but we're also potentially kind of slowly altering the global monetary system here. We're kind of running out of room. So that's why I think there's some similarities to the late 60s as well.
Gotcha. That makes sense. And I guess, how would you characterize the shaking up of the monetary system today? I think that could potentially transition to our next question. But yeah, how is this equivalent to the 60s?
Well, it's in a sense that, so the 60s, the problem there was that the existing system is breaking down underneath the surface. So it didn't break on top yet, but it was breaking down underneath the surface, which was that the United States was running very, very large trade deficits, and so gold was flowing out of the country. So that was becoming unsustainable. And it's kind of one of those things that didn't show up on the surface until they had to make a political decision to back away from it. So the system we have, the problem we've had for the past 10 or 20 years is, ever since we had the petrodollar system, which was kind of the savior after the Bretton Woods system, they left that system. The petrodollar system was the second attempt to kind of to link the dollar to something. So they in some sense linked it to oil, right? Because they made it so that politically, all over the world, oil is priced in dollars pretty much. So if France wants to buy oil from Saudi Arabia, they pay in dollars, even though the dollar is neither of their currencies. And that makes it so that, countries in the world demand dollars so they can buy oil. And also it makes them so that they, if they want to have that ability to buy oil and other commodities, they want to have some dollars on hand so they can stabilize their own currency, and they have that kind of store of dollars as needed. So they run, hopefully in many cases, they run trade surpluses. They take those dollars and then they put them in treasuries, and they kind of have that store of value. So that worked well for a while, but the problem is, in order to run the global reserve currency, we have to make sure that there's a lot of dollars out there. Because if the whole world's going to price commodities in dollars, we have to get a ton of dollars out there. So the way that works is basically there's a ton of demand for the dollar. It makes it really strong. So it makes our export competitiveness weak. And it also makes our import power very high. So it kind of influences us to run big trade deficits. And that helps get dollars out there. So it's kind of this, depending on how you look at it, it's a virtuous cycle or a vicious cycle. So we run these big trade deficits, we get dollars out there. Now, that worked well at first, right? But after decades of that, we've really kind of exported a lot of our industrial base. Even compared to other developed countries, we made less and less stuff. We exported it all to other places that are, more competitive in that regard. And so we've really kind of displaced a lot of our workers in that sense. But now it's kind of getting towards the straining point of that system, because the U.S. is no longer the biggest commodity importer. That's China. And in addition, after World War II, the U.S. was something like 40% of global GDP, right? Because Europe and Japan were crushed and the emerging markets were small. Whereas when those developed countries rebuilt back up over the decades, and as you had the rise of China and other emerging markets, the United States is now like 20% of global GDP, depending on how you measure it. There's a couple of different ways you can measure it, but it's a much smaller share. So it's much harder to run the whole global system on one country's currency if that country is only 20% of world GDP. So we're kind of gradually moving probably to a more decentralized or more like multipolar system. So less kind of dollar centric and more like several currencies that can potentially price oil. So we've seen kind of interest out of Russia lately for pricing their oil in euros. And for example, if you look at trade between China and Russia, 2 years ago it was like 85% dollar based, and now it's down to like 45% dollar based. So it starts with some countries. It's not all countries at the same time, but we are starting to see a little bit more kind of a multipolar kind of currency system slowly emerging. And also we have new technologies that kind of enable that to some extent, like stable coins and other things that kind of give private companies or policymakers more tools to kind of get around some of the current payment systems.
Just a quick follow-up there. Do you think the kind of competitors to SWIFT that we've seen coming out, like I think weren't the Japanese working on one, and the Germans were working on one over there, and the Chinese, of course. Is that play a role in some sort of multi-currency standard that you see?
Yeah, absolutely. Because in order to have a true multipolar or multi-currency system, you have to have, other systems outside of the SWIFT system. So, because right now we control the main pipes in the U.S. Most of that financing goes through New York essentially. But under that other system, if you have kind of true kind of multipolar systems, then you have kind of you might have like a China-based system, you might have a Europe-based system, and then you might have a U.S.-based system. So in that sense, the dollar is still a reserve currency, but it's not necessarily the only reserve currency. So you have kind of more kind of spreading out of what constitutes a reserve currency.
Awesome. Yeah, I've never heard that before. Combining the 40s and the 60s together because of the two different type of characteristics of those times. That's pretty fascinating. Okay, I'd like to jump into the inflation versus deflation debate. This is like one of my personal concerns out there because what's concerning about it is that macro people and gold people or sound money people, Bitcoiners, they can't agree on what is happening. Do we have inflation? Do we have deflation? Maybe it's a deflationary environment with inflationary spikes within that. So yeah, it's just concerning to me that we don't know what's going on. And what's your take on the inflation deflation debate?
Yeah, absolutely. I think that's a challenging debate because it's a couple different facets to it. So one comes down to how you define inflation. So sometimes you have different camps arguing with each other because they define it in different ways, right? So some economic schools define inflation as a growth in the money supply, right? So by definition, you have inflation, and it just kind of goes into say asset prices or other things. Whereas another definition of inflation is consumer price inflation. So you take a basket of goods. There's a couple different ways to measure it. Many of them are understated, but you have at least like a benchmark, and you kind of see what's happening with consumer prices. So those are kind of the two broad definitions of inflation that people look at and then kind of debate over. And then the other complex part is that you have to think kind of in second order way. So we have a very inherently disinflationary environment in the sense that large amounts of debt tend to be deflationary. Rapid technology growth tends to be deflationary. Slowing demographics is deflationary. Globalization, offshoring of labor to cheaper markets, lowers prices in many cases and is deflationary. That doesn't apply to say healthcare or education, right? So the things that we haven't been able to offshore tended to go up in price a lot faster than things we've been able to offshore. If you take all those deflationary forces together, we have, we've been in a 40-year trend of lower and lower, official price inflation. On the other hand, when you get to kind of the end of a long-term debt cycle and you have this much debt relative to GDP in the system, and you have this much wealth concentration, and you kind of like the economy just kind of grinds to a halt because the money's not circulating anymore, and there's really no way to pay off those debts nominally. Usually what happens is you get a ton of policy response, fiscal policy response, monetary policy response to purposely drive inflation. And then you kind of devalue the debts. Instead of defaulting on debts nominally, you devalue them in the sense that you create a ton more currency, and those debts get paid back in weaker currency. And that's what we generally see happen in long-term debt cycles. So, I think the nuance is that we have a very disinflationary backdrop, but then their policy response to that can be very inflationary. And then there are other things that can add to that. If you get supply disruptions, if you reverse globalization and bring kind of supply chains closer to home, you kind of end some of those deflationary trends. And actually, if you look at global trade as a percentage of global GDP, that actually peaked back in 2008. So you can make a pretty compelling argument that globalization kind of peaked in 2008, and ever since then it's been kind of plateauing and if anything, slightly declining. And also the same thing happens if you look at the percent of foreign revenue of the S&P 500. That also peaked in 2008. So we have a pretty clear trend that we've reached peak globalization most likely, or at least even if we hit a slightly higher high, it's not really accelerating anymore. And if anything, it's on a mild decline.
So you touched there on fiscal policy versus monetary policy. So obviously, I think that's the stimulus, right? There was just another one I get that was suggested, or what's the word for it? Put forth by Pelosi, 2.4 trillion. And but are these going to lead to, do you think, temporary inflation, like a shock of inflation, like we might have seen in the 40s, and then return to a deflationary type of environment, or is it possible that fiscal stimulus can create an inflationary feedback loop on itself that can have sustainable inflation in the future?
It can, I think it can create a sustainable loop, and especially if those fiscal deficits are structural, which they increasingly are. So in the 1940s, they didn't really have structural deficits. They had massive deficits in the 40s due to the war, but they were able to then kind of quickly tone those back down. So you had this kind of very brief, the 40s was a very inflationary decade. You had 3 big spikes of inflation, but they quickly got that under control in the 50s, and you started to kind of get that, you inflate a lot of the debt away, but then from there you're able to kind of work that back down pretty easily. Whereas now, because our society is so top heavy in terms of demographics, and we have very large entitlement programs that we promised ourselves decades ago, and so deficits were growing before the pandemic. So we were already up to, we had kind of recession level deficits right before this all started. And now, of course, we have kind of depression level deficits or war level deficits, which is kind of it's tied to this specific recession. So, a lot of people thought that the monetary policy of 2008, 2009 would be inflationary, but for the most part, that sort of monetary only response is not very inflationary, because all they were kind of redoing is recapitalizing the banking system, going back up against a deflationary shock, right? But when you get to the point where you're injecting trillions of dollars purely into the real economy through the fiscal spending route, and of course, the monetary policy still plays a role, because they have to buy a lot of the bonds because there's not enough private buyers to buy all of that massive bond issuance. So whenever you have the fiscal authority and the monetary authority working together to run very large deficits that are monetized, that tends to be inflationary. So we saw that in the 1940s, and they ran massive double-digit deficits multiple years in a row, and that ended up being pretty inflationary. Now here we've had this one really big kind of deficit year, and we have seen a rebound in inflation expectations. So we had a big deflationary shock in March. We've since seen a kind of a rebound in inflation expectations and reported CPI. Now it kind of comes down to whether or not this next stimulus passes and when. So originally Democrats were looking at 3 trillion, Republicans were looking at 1 trillion. Pelosi was talking about then toning it down to 2.4 trillion. I believe the one they announced yesterday was like 2.2 trillion. Republicans have moved up to like 1.5 trillion. So it looks increasingly likely that eventually they're going to meet somewhere in the middle, around 2 trillion. But of course, the question is when. Will they pass that before the election? Will it end up getting kind of dragged out? Will they pass it in February? Maybe. We'll see. So I do think that they're going to probably run very large deficits, for the next several years, because they have a 5% of GDP background deficit that they went into this with. That's kind of the structural demographic deficit. But then on top of that, you have the extra deficits from unemployment benefits, from lower tax revenues, and then any sort of stimulus that they put on top of that, especially because a lot of that will be deliberate to try to inflate away some of the debt.
Yeah, I think Christian has a good question for you next on the how does Bitcoin fit into that. But I wanted to ask a question about the competitive devaluation. So yeah, if the U.S. is doing all this fiscal stimulus, Europe is doing all this fiscal stimulus, and then there was just a headline today that Europe has the worst deflation in over 5 years, even after all of their stimulus. So how does competitive devaluation work into this, and even including China in there, because there's been a pretty significant move of the dollar versus the renminbi over the last month or so.
Absolutely. I think there are 2 kind of major variables to look at. So one, of course, is the rate of change of that kind of fiscal spending, or the relative size of that relative to GDP. So far this year, the United States has been one of the most aggressive fiscal stimulus. Big, we're running larger deficits as a percentage of GDP than most of our developed peers. So that can kind of play a role in relative speeds of different currency devaluation. And of course, some political jurisdictions have an easier time running deficits. So in Europe, because they all these different sovereign countries shared their currency system, they have kind of the extra bureaucracy layer when it comes to running big deficits. So they kind of have an extra kind of layer to go through, which really slows down and reduces the deficits that they can run, because they have to get more people to agree. Whereas in, say, the United States or China or Japan, there's less hoops to go through. So China would have the least hoops to go through because they're more authoritarian. Japan, they're not very politically polarized, so they have the ability to run pretty big deficits if they choose to. The United States is polarized, but with fewer layers to go through than Europe. So that's kind of the first point, is the rate of the different deficits and the monetization that's happening. The second thing is kind of a major variable for currency strength is the current account balance and the trade balance. So when you have a country that's exporting more than it's importing, it's running, a trade surplus, and that tends to strengthen the currency, right? Because if their currency weakens, it makes their exports even more competitive, and it reduces their import power. So if anything, it can widen their trade surplus, and that tends to strengthen the currency. And one of the case studies I like to do is to look at Japan. So everybody looks at Japan as, because they did the most quantitative easing as a percentage of GDP relative to most other countries, right? So their central bank balance sheets over 100% of their GDP. And that really started in 2012. So prior to then, they had pretty gradual QE, but from 2012 through now, it just kind of it went parabolic. It just utterly the balance sheet just soared. And so they had back in 2012, Japan usually runs trade surpluses and current account surpluses. But in 2012, there was a lot of economic weakness, and they were actually kind of running a small kind of trade deficit, which is unusual for Japan. And their current account balance is roughly balanced. They weren't really negative there, but they weren't positive anymore. And so they started this massive QE program. And so they actually did pretty quickly devalue the yen. So from 2012 to 2015, the yen devalued pretty significantly compared to the dollar. But by that point, their trade balance kind of normalized. So their trade balance went back to about zero from being in a minor deficit, and their current account balance turned positive again. So from there, even though they kept doing QE at a very fast rate, their currency stopped weakening compared to the dollar. And if anything, it actually mildly strengthened compared to the dollar from there, because that balanced trade situation kind of sets a floor to how quickly they can devalue their currency. And so if you look at Japan and Europe and China, they all have current account surpluses essentially. So Europe has one, Japan has one. China used to have a big one, but theirs has been decreasing in recent years, but they still are kind of roughly balanced in that regard. The United States is different because we have a very large trade deficit and current account deficit. So we kind of are more vulnerable if we all kind of print together. If we all print aggressively, the U.S. can potentially devalue theirs more than the others, and that's something I think to watch out for. And it's not going to be linear, right? Because there are occasional periods where they stop running large fiscal stimulus, like we have kind of happening right now. So of course we're getting a rebound in the dollar a little bit. We're getting kind of less devaluation happening for this kind of few months. But I think over kind of a multi-year period, countries that have kind of a bigger trade deficits and that are running kind of larger fiscal deficits, they tend to be more exposed to devaluation.
So Lyn, I want to ask you the Bitcoin question, but before getting into that, I kind of want to like push back a little bit and kind of get what you're thinking here. When Jeff Snyder came onto the show, he was like, these countries like China and Russia, the only reason they're creating alternatives is because there's not enough dollars. Like there's just this dollar shortage. Like how does the dollar being the global reserve currency kind of play into and make the United States different than some of these other countries that, they have more, manufacturing and more exporting, onshore, but, they're not exporting their currency.
Yeah, so there's a couple of different kind of time periods you can look into. So of course, if you look back, if you go back to the 30s and 40s, Britain was a global reserve currency at the time, and that didn't really stop them from devaluing. They devalued even more than the dollar did back then, even though they were the global reserve currency. And of course, there's always factors there because they were more heavily involved in the war than the U.S. was in many cases. Because the U.S., we had the luxury of fighting offshore, right? So now, if you fast forward to earlier this year in March, we kind of saw that global dollar shortage, come to a head. So there's at the time I think there was like $13 trillion in offshore USD debt. And so that's debt in corporations and sometimes at the sovereign level of countries that can't print dollars. And so what happens is, when we had that kind of pandemic hit, we had China kind of, they were cutting their commodity imports. So we had a big decline in commodity prices. And that, of course, had, resulted in less kind of like global trade happening. So you had less dollars going around the system. So it's harder and harder for those companies and those countries to get dollars to service those debts. So that's what they mean by a dollar shortage. And so you saw a very rapid spike in the dollar in March. So it kind of, it briefly sank from, maybe the dollar index was like 99, it sank to 96, but then it shot up to like 103, like in a matter of weeks. And so that's because everybody was scrambling for dollars at the same time. Now, the problem there is if it gets acute enough, those foreign, sources, they begin selling U.S. assets. So even though they had $13 trillion in U.S. debt, they actually owned $40 trillion in U.S. assets. So that includes stocks, corporate bonds, treasury bonds, real estate. And of course, some of those are more liquid than others. So treasuries tend to be the most liquid. So what we saw in March and April was that the foreign sector was selling treasuries to get dollars because they had that dollar shortage. Now, the Federal Reserve can't have that because the treasury market became illiquid in March, right? So you can't have the most liquid market in the world become illiquid and stop working. And we saw kind of a brief period where even though yields had declined, they then quickly shot back up in March. For that, there's kind of a 2-week period where yields were going back up. And that was because foreigners were selling treasuries. So what the Federal Reserve did was they stepped in and they bought $1 trillion worth of treasuries with new dollars in 3 weeks, right in that kind of late March, early April period. And that kind of reliquefied the treasury market, and it kind of helped ease the dollar shortage. And then, of course, they launched all sorts of swap lines and things like that to try to, kind of loan dollars to foreign sector so that they stop selling treasuries. And I think that's kind of that policy response you have to look into. So left to its own devices, there is a dollar shortage, and that can create a very strong dollar environment. But because that, when that shortage plays out, it's so damaging to U.S. markets that the Federal Reserve essentially has to come in and ease that burden. And so if you take into account the policy response, and when you're running very large deficits, when you're monetizing those deficits, and when you're kind of making sure that the dollar shortage is not acute, the overall kind of picture is that you get a dollar devaluation. And that's so far what we've seen this year. So the dollar is down year to date, even though it's the global reserve currency during a pandemic. Kind of left to its own devices, you'd think that would go up to some extent because people would flood into the dollar. They'd want to hold the strongest currency. They want to hold the global reserve currency. But then the policy response against that can kind of push back against that.
Okay, so you think the policy response actually is effective in pushing against that natural cycle? I guess let's switch it over to Bitcoin. Like, where does Bitcoin play into your macro equation?
So it's similar to gold, but kind of on steroids, right? Because whenever you have, pure like we have now, you're likely to have negative real interest rates for quite a while. So if we go back to the 30s and 40s example, you had kind of negative real interest rates. And there is about a 40-year period where if you bought a 10-year treasury and held it to maturity, you lost money relative to inflation. So there were kind of brief years in like the 50s where you could get kind of a mild positive return. But for the most part, there was a 40-year period from kind of the late 30s to the late 70s where if you bought and held a 10-year treasury, you lost purchasing power, even though you got your money back because you got your money back in weaker dollars. And of course, that overlaps almost perfectly with the period where it was illegal for Americans to own gold, because that would have been one of the major release valves that you could go to. So if you're just kind of losing money by holding treasuries, you can instead hold money, kind of save your money by holding gold. And so whenever you have that negative real yield environment, it's really good for scarce assets because, the biggest downside for scarce assets is that on their own, they don't necessarily pay a yield. And then sometimes you have an expense for transacting in them or storing them. But if real yields are negative, that whole opportunity cost goes away. And of course, in some cases, you can get a yield with those investments. So for example, India has gold bonds that have a positive yield. And now there's institutions where you can get a yield with Bitcoin as well. Basically you take on some counterparty risk to get a yield. So it kind of, whenever we kind of back in that environment now where we have negative real yields, and that tends to be very good for those sort of monetary assets that are outside of the system that have scarcity. So gold's kind of the blue chip version of that because, the market capitalization is something like $10 trillion. It's very well established. Whereas Bitcoin is the newer version of that. So it's a much smaller market cap. So it's more volatile, but it also means it has a lot more upside potential. So that's kind of how I'm playing it, where, when you have this, because sovereign debt is so high, and because they're actively trying to encourage higher inflation, you're very likely to have negative real yields for many, many years. And that's just an extraordinarily good environment for commodities in general, but especially monetary commodities.
So kind of just to follow up on that, like, so you think Bitcoin's going to perform well. Is there a chance for Bitcoin to become a gold-esque relevant asset in the global monetary environment?
I think over time, I think it's kind of got like a long process to go through. At the current time, gold's kind of special because it kind of counts as risk-free among banks around the world, right? So that's kind of a privileged status. Bitcoin, because it's a small market cap, it's more about the potential for what it will become. So right now, it's a very volatile kind of speculative asset. But people that are buying it are kind of looking really far ahead and saying that eventually, if enough money comes into this kind of network, the volatility will dampen, the market cap will be a lot higher, and then it can be a lot more kind of useful as kind of a store of value. Right now, it's more of a speculative store of growth expectations. So, we've already seen, a couple different companies start to hold some of their cash in Bitcoin. And we've seen some interest from, kind of the smaller sovereigns that are kind of giving some incentives to have Bitcoin mining in their country. So I do think that, especially on smaller companies or smaller countries, you could start to see that, Bitcoin be adopted in a similar way to gold. And then if it keeps catching on, it could work its way up from there.
Angela, do you want to jump to your question? Sorry.
Yeah, I can just ask the next one here. So, comparing Bitcoin then and this era, or at least the existence of Bitcoin during this era, compared, going back and comparing it to the 40s and the 60s, do you think that Bitcoin has the possibility to make it different this time, or do you think that we'll have another a decade of slow and deflationary environment, and eventually we'll get out of this, like the 30s into the 40s and the 50s?
I think that's very hard to predict because in that sense, you're kind of predicting human behavior. But compared to the 30s and 40s, we have a lot more information now, right? So we can monitor this stuff in real time way easier than they could back then, right? So they couldn't just, go up on the online back then and say, okay, inflation is this much and my treasury is yielding this much. Wait a second, that's not good. Why is my treasury losing value? Like, it's just kind of, you had less information to work with, much slower information. So now we kind of see this all playing out in real time. We have social networks where we can all communicate the ideas to each other. So that definitely adds a whole nother, kind of order onto this whole thing, right? Because you have the deflationary backdrop, you have the inflationary response, but now we also have, more accessible information and faster ways to share that information. So yeah, you could definitely see kind of a quicker exodus, especially from faster money or smarter money out of the system. Now, a lot of money has certain mandates, like pension funds or insurance companies or other sort of institutions that have to hold, say, a lot of cash, a lot of treasuries, things like that. Um, you also have kind of fund managers that they say they have to buy stocks or they have to buy bonds. Whereas if you have kind of a discretionary allocation, so you can buy any asset class you want, and you have all this real-time information, if we do see inflation starting to occur, right? Because we're still kind of in that still kind of disinflation environment, right? So we still have kind of low, at least low official CPI, kind of measures and low kind of official inflation expectations as measured by the TIPS market. But if we go forward into 2021, 2022, 2023, if you do start to see higher and higher inflation, but you still have very low kind of bond yields and interest rates, I definitely think you could see kind of a more disorderly rush into some of these scarce assets like gold and Bitcoin.
Go ahead, CK. You got the next one. Oh, you're muted.
Sorry. So I mean, yeah, I guess my last question is kind of like bringing the comparison back to like the 60s and in that period of time, or sorry, the 40s in that period of time. Gold kind of suffered the fate of being centralized and getting confiscated and getting 6102'd, as they say in the Bitcoin community. Like, do you see Bitcoin as if it does take on a more legitimate role, does it properties kind of prevent it from suffering gold's fates in your eyes? And how do you kind of see it compared to, like, how do you see Bitcoin's emergence as rubbing up against governments?
Sure, I think it, inherently has more resilience than gold does to like confiscation and things like that, right? Because it's very hard to get around that. Now with gold, the interesting thing was it was technically illegal to own it, but it actually wasn't very well enforced because they didn't really send people door to door to check on it, right? So it was, if you had it in your like bank deposit box, you probably lost that, and if you were to get caught, there's a pretty big penalty for it. But back then, a lot of people just didn't really stick to it, and they didn't really have a good way to enforce it. And so it's kind of it's not a great kind of rule to begin with, because it's hard to, if you pass a law that you can't really enforce, it's not necessarily a very good law. So now Bitcoin is even harder to enforce if you were to ban Bitcoin. So I think it kind of depends on kind of what time period you look at, right? Because the longer this goes on, the harder and harder it gets to disrupt Bitcoin, right? Because right now, if they went all out kind of next week and they said, okay, you can't operate exchanges, it's illegal to own it, then basically, you have kind of a big shock to the network because you won't be able to have institutional money flowing into it. You'd have kind of a lot of weaker hands get out of it, right? Because it's now illegal. Of course, you still have kind of a black market happening, and you'd have people in other countries where it is legal to keep doing it, right? But you'd have a shock to this relatively small network. However, the longer this goes on, so the more institutional money that flows into it, the more companies that put a percentage of their treasury reserves into it, the more the bigger and bigger assets under management that Fidelity's institutional level custodian brings into it, the more kind of Paul Tudor Jones of the world invest in Bitcoin, the bigger the market cap gets, so the more kind of amount of value that they would be disrupting by doing something like that, and the more kind of political donors that own Bitcoin now, right? So the more entrenched it gets, the bigger it gets almost impossible to stop it at a certain point. So, I think now, because there's still not a ton of institutional money into it, there's still some degree of vulnerability, but the more you go, kind of the faster and more invincible that train gets.
So our last question here before we wrap it up is going to be on portfolio construction, or how do you compare Bitcoin in an individual's portfolio to gold and maybe a lower risk thing like bonds? What I've heard you speak about this in the past. Can you just walk us through what you think of in that regard?
So I think in some senses it's similar to silver in the sense that it kind of works like gold, but with a lot more volatility. So the problem with bonds in this environment is that they're going to produce very, very low returns over the next decade, and probably negative real returns, because if you have a treasury yielding less than 1%, the Fed's inflation target is 2%. They want to try to overshoot it. Now, whether they can or not depends in part on fiscal policy, right? So the Fed can't just choose what inflation is, but especially because it's different ways to measure it and stuff. But you're almost guaranteed to have a negative real return in treasuries. So that's kind of the opportunity cost for having a bond allocation, in the sense that it's low volatility, but also low returning. So, historically, in a very low interest rate environment, putting some of that into gold can be, in some cases, it can increase your volatility slightly, but also you have that kind of defensive, relatively low volatility asset. And then silver can kind of supercharge that, right? So silver has much bigger up and down swings than gold, but tends to follow kind of certain similar patterns. So it's kind of a more risk taker's version of gold. Bitcoin is similar in the sense that it's a smaller market cap. There's like a lot of volatility. So it kind of just it changes what your position size can be relative to your conviction. So if someone's 70 and they don't know a ton about Bitcoin, you can't necessarily put as much of your portfolio in it that you could compared to, say, gold, as an example. But if someone's younger, or someone's very knowledgeable about Bitcoin, or very kind of heavily involved in that, and kind of has high conviction on the asset, they can dial it up, a little bit more than say an older investor or a more hands-off investor could. So I view Bitcoin as kind of a somewhat uncorrelated asset, in the sense that it's somewhat correlated to liquidity events, right? So if you have kind of fiscal stimulus shut off or turn back on, you kind of get stocks, gold, and Bitcoin often going in the same direction. But over kind of a multi-year long term, you can have things like gold and Bitcoin decouple from the stock market. And so Bitcoin is potentially Paul Tudor Jones described it as the fastest horse in the race. And I think that's kind of a good way to describe it, that if some of these more inflationary scenarios play out, or even if you just have this really kind of negative yielding environment with very large deficits kind of play out, regardless to what inflation ends up being, that's a very good environment for scarce assets in general. And Bitcoin, just as kind of the newer one, as kind of one with a lot of kind of mobility to it, and it's very popular among younger investors. I think it has kind of a lot of upside potential. So I like it as, I kind of made the case to the public as sort of having a non-zero Bitcoin position to start with. I think that's kind of a good way to think about it. And then people, of course, can dial it up from there, depending on their age, their risk tolerance, their conviction, and their knowledge in the asset.
Fantastic. Well, Lyn, this was an absolutely information-packed and dense episode. We touched on a lot of different subjects, and I learned a lot just from hearing you articulate these different scenarios and making the comparisons to the different time periods. So thank you so much for coming onto the show. Thank you so much for what you do in the macro and Bitcoin community in general. Just to close it out, where can people find you? And yeah, I guess if you want to, for anyone to reach out to you, who do you want to hear from?
Sure. So I'm at lynalden.com, and I'm also at Lyn Alden Contact on Twitter. So people can reach out to me if they have questions. I try to answer my emails wherever possible. Like I said, I partnered with George Gavin for his program, and then also work on elliotwavetrader.net. So we actually have someone that, for example, does Bitcoin kind of technical analysis as well there. So the kind of different flavors of how they want to, look at my work.
Fantastic. Well, again, thanks so much for coming on to the show. You guys can find me at CK_snarks and at Bitcoin Magazine. You can find the show at Bitcoin Magazine. You can find Ansel at Ansel Lindner, and make sure to look up the Bitcoin Dictionary at bitcoindictionary.cc. Again, thank you again, Lyn, and thanks to everyone for watching and listening.
Yep. Thanks for having me.